Hey, Eric here from 5minuteinvesting.com, and today we're going to talk about the best way to invest $100,000. So when you're looking at $100,000, this is actually quite a good amount to start investing and start evaluating your options carefully. Now, when you're looking at investing, there are generally three options. One is real estate, and if you have a house, you definitely want to consider that as part of your portfolio. And two, stocks. Now, in this video, I'm actually going to exclude mutual funds, ETF funds. I think those are relatively straightforward, and if you want more information on it, you just go to the bank and a teller will advise you on the type of mutual funds you can buy. So this is about managing your own portfolio. Now, if you have $100,000, I would actually try to buy real estate as much as possible. And now, the reason is because real estate has leverage. When you get a mortgage, you are actually investing using more than just your money, but the bank's money as well. So using leverage will multiply your return. So if I have 100,000, I can probably invest in one, maybe two properties. That'll be stretching it a little. And if you don't have sufficient money to invest in real estate, you can actually consider something called a REIT, which is Real Estate Investment Trust. Now, a REIT is kind of like a mutual fund, but for real estate, and this allows you to invest in larger real estate projects such as shopping malls and larger developments. So you just need to do your research on a REIT and whether the property is going to make money and it's going to be generating income and the land is going to increase in value. So then let's talk about stocks. Now, some people like to invest in stocks using no leverage. And for myself, I like to invest in stocks using leverage because it helps improve my return. And I have a very high probability strategy, which allows me to be very comfortable when I'm investing in a stock market using leverage. Now, leverage is really just another word for debt. So when you are looking at your investment portfolio of $100,000, you also want to consider the amount of debt you have. So for example, when you're looking at real estate, you want to think about what is the interest rate on my mortgage? Is it 2-3%? Is it 3-4%? And that will influence the cash flow, and that's one of the main consideration for real estate investing. And the banks will require you to have at least a certain amount of down payment to invest in real estate, so that is actually the other consideration. Whatever money you cannot use to invest in real estate, I'll just put it towards stocks. And when you use leverage for stocks, you actually don't need to have a down payment. You don't need as large of a down payment to invest in stocks with leverage. Now, if you have any credit card debt or any debt that is not used to purchase an asset, these are usually considered to be bad debt. And you want to get rid of these and use your portfolio to pay down bad debt. So if you have a credit card balance of $10,000, okay, and credit card charges you 20 to 30% in terms of interest. So you want to pay that down quickly because your real estate return might not be as high. So that is what this little squiggly line is about. It's about the interest rate of the debt needs to be lower than your return. And remember, your return fluctuates. So you want to be conservative in terms of what kind of return you can make and make sure the interest rate for debt is less than that. Now, good debt is really the debt you use to buy assets, buy real estate. If you know how to use leverage for stocks, then you will be using it to buy stocks, like myself. So you want to focus on building good debt instead of bad debt. So if you bring the idea of leverage into your portfolio, then what you're really controlling is more than $100,000. Now, let's say you use $50,000 as a down payment to buy a $200,000 house. So using $50,000, you're actually controlling assets that are worth $200,000. So you see how bringing in the concepts of leverage really changes the game for money management, wealth management, and investing. Okay, So I think that is pretty intuitive, and let's talk about how to use debt or leverage for stock investing. And I think that's where most of us will have questions for. Now, when you're investing in stocks and you already invested in real estate, you are already diversified across two different industries, real estate and stocks. So when you're looking at stocks, you're really diversifying again within stock portfolio. Now, I have another video on diversification and how many stocks you need to hold on to diversify. But essentially, with $100,000, let's say $50,000 goes to real estate, then the remaining $50,000 will go to stocks. So a super simple rule of thumb is just to pick the top 5 stocks that you like and wait to enter at a discount. So this means you can invest in 5 stocks for around 10K each, which is a pretty good amount to start. Now, some of you might be thinking, well, 5 stocks, that's not really enough to reap the benefits of diversification. Well, the answer is you already reaped like 80% of the benefits of diversification. And if you Google the chart called the diversification effect, you're actually going to see a curve which shows you how much diversification you're getting by holding a certain amount of stocks. Once you're holding 5 to 10 stocks, you pretty much have 80% of the effect. So if you hold 50 stocks versus 100, the incremental benefit is minimal. So if you got time, you can actually search up that specific chart. Now, once you selected these 5 stocks, then you can use stock options to multiply your return. Now, I know a lot of us here are actually not familiar with stock option. It's a form of leverage. So if you're not familiar with stock options and you haven't mastered it, do not use it, because you can only apply leverage in very specific situations. For example, you can't use stock options on a penny stock with so much of your life savings, because that's going to be very risky. And the return might be great, but then the loss also might be great for you. So you need to learn how to use stock options effectively. All right, so then let's talk about what kind of return you can expect. It's kind of weird I left this to the for the last part, but when you're investing in real estate, other than Vancouver, which the real estate prices are crazy, the general market for real estate increases around 7% to 10%, depending on the neighborhood, of course. So I assume when you invest in real estate, you're actually going to pick a good real estate that you think the price will increase. So if you have a 20% down and the real estate increases by around 10%, so assuming it's cash flow positive or break even, then the capital gain alone should give you around 50% return. And here I wrote down the expected return for real estate, which is somewhere between 25 to 100%, depending on how aggressive or how quickly the market increases. If the market is increasing 20% that year, then your return will probably be closer to 100%. So that is really the return you're looking at when you're investing in real estate using leverage. Okay? And if you are investing in stocks with stock options, then the return you would expect is actually 30%. Now, you will see that these numbers are actually quite high from most of our understanding, because when you invest in the stock market without any leverage, which is just going to the bank and getting an ETF, then chances are you're getting somewhere around 7%. And that's, if you invest in bonds, you see how I didn't put any bonds here, you're really getting 3 to 4%. So it's not a lot. So if you invest in a ETF fund that has 50% bonds and 50% stocks, you're getting like 5%, more or less. Maybe if you minus transaction costs or management fee, it actually gives you only 4%. So that's why I didn't even put it on here. So when you have $100,000 and you're able to make this kind of return from the market, your portfolio will actually grow quite quickly. And this shortens the horizon. This shortens the time you need to prepare for retirement. Because a lot of people think you need $1 million to retire, which is true if you are only making 3 to 5%. But if you're making somewhere higher, like 10%, 20%, or even 30% from the market, then the amount of money you need to retire is actually a lot lower. So based on my quick calculation, is somewhere between 300K to 500K. And if you already have 100K, you are not that far off. So best of luck. Let me know if you have any questions. You can leave a comment below, or you can share the video if you like it.